Hey guys, what's up? This is Jason, certified financial planner with Advise Edge and host of Fighting Words Financial. Today, I want to talk about one way to make money while you sleep. Yeah, baby, I'm talking about passive income, the way to make money to get your money to make money, and you don't have to do anything at all. And the type of passive income we're going to talk about today is peer-to-peer lending. Now, I'm pretty excited about talking about peer-to-peer lending today because since I started my own company last summer, I can finally actually engage in active peer-to-peer lending. Before, when I worked for a number of financial companies, they considered it a conflict of interest for one reason or another. I certainly didn't see it that way, but I had a small account. I just wasn't allowed to actively trade in it for a long time or actively make investments. But now that I'm on my own and I'm not in the business of lending money, and I'm not in the business of selling products. There's no conflict of interest whatsoever, and I can talk about this to my heart's content. First, I'm going to talk about how peer-to-peer lending works, both from the perspective of the borrower and the investor. Now, if you're watching this, you're probably more interested in the investor side, and I'm definitely going to concentrate on the investor side. Second, I'm actually going to show you guys my own personal account. I've had one since, I think, roughly 2011 or so it's been quite a long time. I had a little bit of money in it at first, and it's only been over the last 2 years or so that I've been able to contribute more funds into it. But I'm going to show you the nitty gritty of how it works, how much money I've made, and all that. Third, we're going to go over some of the limitations and the negative sides of peer-to-peer lending in general. And finally, if you stick around long enough to the end of the video, I'll talk about why I'm really excited about this type of investing and why I might be putting a lot more money into the future and why it looks like it's going to be a permanent part of my investment portfolio. A little disclaimer before I get started on showing you guys my account. I'm not being paid by Prosper.com, Lending Club, or any other peer-to-peer lending service. It's not that I wouldn't like to be part of an affiliate program and get paid when you guys sign up through one of my videos. It's just that I don't have enough subscribers to qualify right now, and they already said no. I guess that means it's a good time for me to ask you guys to subscribe and hit the like button so I can eventually get on these affiliate programs. All right, let's get into my account. Hold on just a minute while I pull everything up. Okay, folks, I'm going to move myself up into the corner. This is my peer-to-peer lending account with Prosper.com. What is peer-to-peer lending? Peer-to-peer lending, also known as P2P lending, is a technology-enabled system like you through a website or an app where individual investors fund loans or small portions of loans to individual borrowers. It's also called marketplace lending, and peer-to-peer lending is really growing as an alternative to traditional lending. So I started this account out long ago in 2011, and literally 3 months after I started the account, I started working for a new company, and they said, hey, you can't have an actively traded account or actively managed account on this. You just have to let the loans go. So for years, I think I put $400 in it initially, and then didn't put any more money into it at all until 2018. And from 2018 on, I don't think I put more than about $25 a month more. Now, I might have put in $25 twice a month a couple of times, but it hasn't been much more than that. So we're probably looking at a total of less than $1,000 of investment, and it's just grown over time. But what it's really given me over time is a good amount of data where I can actually look at the performance of the account, and I can say this is what's worked, this is what hasn't worked, and I can talk about some of the changes that have gone over the account. So if you look, the total value of my account here is $2,466.35. You know what? I should probably tell my wife about this. I don't even think she knows that I've been doing this. So the amount of cash that I have in here is $40.53. The amount of notes, which is notes is $2,425.81. The amount of notes is actually the amount of loans that I have out there. All right. So, and if you look at this next number, the annualized return on those notes is 5.35%. Now, that's not bad. It's not great, but it's not bad. It's not stock market returns. But then again, this is not a stock market investment. This is not a bond investment. This is something completely different. This is a microloan investment. When I talk about microloans, I don't think that I have a single note in this portfolio that is more than $25. I don't think that I do. All right. So, and we're going to talk about how that is. So if you are an investor and you're coming in to look at these different borrowers, what you want to do is you want to browse the listings. And I'm going to talk about, this is one way to do it. And this is one of the ways that I made some mistakes early on, is that I would browse the listings every day and I would sort of pick and choose which ones I wanted, right? So if you browse the listings, you can see what's out there to bid on today. Today, you can see the rating here is AA. For if this person wants to do debt consolidation, they want to borrow $14,000. The yield on the loan that they're taking out is going to be 6.49%, meaning that's the interest rate that they're going to be charged. So this loan is $597. There's only $597 left on it. It is 96% funded, meaning there's enough other investors out there that think that this is a good investment for them, and so they put money into there. If I wanted to do it, I could take $25, put it into this loan. I'm expected to earn 6.49%, so long as the loan doesn't go belly up and they don't, basically, so long as they stop paying or keep paying the loans. Now, if you look down here, you see this guy with a rating of B. He wants to do a home improvement. He wants to take out $15,000, and his rate of return is going to be 11%. Right now, it's 81% funded. And there's still 13 days left, meaning there's a lot of people that have confidence in this. But take a look at the loan rating here. If I take a look at this listing ID, I'm gonna look at the details on here. So the interest rate is correspondingly higher. The first loan we looked at, the interest rate was 7%. This one's close to 12%. We can see that the monthly payment is going to be $498. Processor is going to charge you a 1% fee on everything that comes back to you. That is unfortunate, but I don't expect them to work for free. So now I want to take a look at the borrower's credit profile. So he's got a Prosper rating of B, right? His credit score is not bad. It's between 700 and 719. His processor score, this is their proprietary risk score, 7, which is not great, which is why he's rated the B. There's no delinquencies right now whatsoever. He's had one credit inquiry in the last 6 months. His first line of credit, though, was in 2009, so he can't be that old. And he's got 8 lines of credit open, 12 total lines of credit, and a revolving credit balance of $4,739, which means that he already has debt out there, and he's using 85% of his available debt. And the fact is, he doesn't have a mortgage. So if he only got his first credit line in 2009, right? He's got $4,739 out there. That represents 85% of his bank card credit utilization, and he has no mortgage. First of all, I mean, I don't know if he doesn't have a mortgage and he's only had credit for a few years. Maybe he paid off his house, but maybe this is not really for a home improvement or anything like that. Also, the debt to income ratio is high. It's at 48%. I think their cutoff is 50%. So it's really at the very edge of that. His occupation is skilled labor. That doesn't tell me what he does, and he's been at that job for 3 years or so. This is a loan that if I were picking and choosing loans to invest in, this is one that I would probably pass on, or this Prosper rating B loan would be something that would be a much smaller portion of my portfolio. Now, it's higher risk, of course, but with that higher risk, of course, comes more reward. You do have more in the way of interest rate. Okay. So if I go and I look at something else, we're looking at medical dental costs. This person is in verification stage 3, meaning they've already provided the vast majority of the documents that they need. They live in Maryland. The borrower's rate is 5.31, which means that my rate's going to be 4.31. It's 69% funded. The credit profile looks pretty good. The occupation is a nurse. That is excellent. The debt to income ratio is lower than the one we looked at before. She's been in her profession, or he has been in his profession, for 9 years and 10 months. Bank card utilization is only at 6%. They have a mortgage, yes, meaning that they own their own home. So I'm not sure why they need money for dental, unless this is purely cosmetic stuff. But the FICO range is between 820 and 850. This person looks pretty good for a loan, meaning this is one that I would probably put some funds into. It seems like a pretty low risk investment. Low risk investment, of course, means low potential for return. We're looking at, after Prosper taking their fee, that is going to be 4.31%. Okay. Typically, there are more loans in this that are available for you to bid on. I'm going to show you my portfolio of loans now. I'm going to go back to my investments. There we go. And I'm going to show you my portfolio, and I'm going to show you what it is that I do differently. I do not pick and choose loans. I set everything on automatic, meaning everything is done automatically. I set the kind of standard that I want as far as how much I want in each category. It's very close to what their categories are too. I just have a little bit more on some riskier stuff, and I let the machine do it automatically. I found that picking and choosing loans based on how I felt the borrower was able to pay back the loan really didn't work any better than the computer did. So I tried doing it my way for a while. I had some defaults in it, and I wasn't making the return that I wanted. I let the computer take care of it, let their algorithm take care of it, and now I'm making a little bit more return. If you look, the yield on the loans that I have, the average yield on there is much higher than the average return on my portfolio. Why is that? Well, that is because there's always going to be some defaults in here. Let's find some of these. So I've got roughly 250 loans out there. Some of the loans were completely paid up, meaning this guy took out a 3-year loan but paid it off in a few months. So my yield on this was 6%, but it was $25 loan. I made 12 cents on it, and made 6%, right? So pretty much all of these are $25 loans are between 3 and 5 years. Let me see if I can find one here. All right, so this guy is late on his loan, meaning this is a AAA borrower. He's 61 to 90 days late. He's only paying me back $1.52. Sometimes this is a problem with the payments getting rejected by the bank. Sometimes it's someone who just borrowed the money and just is not going to pay it back because they lost their job or something like that. All right, so here's when what really drags down your payments down. Other debt sold. So this right here is a guy that was in default for a long time. He wasn't paying back his loan, and the debt was sold. Now, I'll end up getting a maximum back of 40% of the outstanding amount, which is the 24.28. I'm not going to get any more than that back. Prosper takes 60% of that or so as a fee when they have to be the one to recover any of the lost debt. Right? But they're the ones doing all that. I'm not doing it, and this is kind of one. So if you're doing one of these loan accounts, you kind of have to accept the fact that some of these loans are going to default. People just aren't going to pay you back. So when I'm looking at this sort of 20%, 23%, 30%, 9%, that's not what I'm achieving over time. These small defaults and these small canceled loans are going to drag down your portfolio performance over time. Now, if you look, though, there are plenty of people that go ahead and pay these loans off well ahead of time. Typically, I like to keep an eye on people like that. If I look at the Prosper history, like if we look at this guy right here, the original listing info, the borrower's original credit profile, and we look at whether or not usually there's on here like the Prosper score rating is really, really high, probably because he's already paid off a loan, right? His credit looks good, of course. He's got 25 lines of credit there. He still has a revolving credit balance, but he did pay us off completely. Everyone who he borrowed money from in this loan, we got paid off completely. I don't know if that's because he consolidated his debt somewhere else. I don't know how he did it, but it's going to raise his Prosper credit profile now that he's paid off a loan. I really like to take the loans when I can, or fund loans that I can when somebody has already paid off a loan to Prosper. All right. Go. So I'm going to head back to my investment portfolio, and I'm going to show you guys auto invest. Okay. So the auto invest feature is on. Right. Auto invest basically is the feature that I use to do all of my investing at this point. I don't really pay any attention to this account. I can tell you that between 2008 and 2011 and 2018, I probably looked at my account 2 or 3 times and no more than that. And it just kept growing and growing and growing. And the reason I didn't look at it because I couldn't really engage in the business of investing in that at that point. But so one of the things I was allowed to do by the companies I worked for was to use this auto invest feature. Both Lending Club and Prosper.com, they both have an auto invest feature. They might name it differently, but this is the way it is with with Prosper. You can choose to have the AB weighted return, which is the higher credit quality return, the marketplace mix, or the high risk return, right? So this is where your yield is calculated somewhere around 15%, but because of the high rates of defaults, your historical return is going to be between 3.4 and 7.4. I have chosen to have a marketplace like mix with keeping 2% of my account in cash at all times. Why is it 2%? I don't know. Maybe if I need an extra $50 or something a month, I don't know, but I've kept it there. So if you look, mine is pretty much spot on right now as far as where I want it to be. This is a custom mix, but it is very close to that marketplace mix, right? Where I have some in the double A, some in the A, B, C, and as the risk grows, my holdings of those decline, right? So I pretty much only do $25 per note because my account is pretty small. As my account grows larger and larger and larger, I'm probably going to have to make the share of what I actually contribute to a note grow, just because there won't be enough notes for me to invest in. So with my current allocation, my yield is 13.2%. The historical returns are 3.4 to 6.9%. Mine is right in the middle there, like 5.5%. And I think that's realistic. Like, you're going to have enough defaults where people don't pay you back that's going to be your overall return. All right. So those are the neat things. The neat things about how it works too is that you can either choose to pick and choose your investments yourself, or you can choose to have it done automatically. I choose to have it done automatically to make this really a passive investment where I'm making money when I'm sleeping. I'm making money every month. So I'm going to be putting more and more funds into these now that I can. So if you wanted to bid on an account or bid on something, actually, why don't we just do that right now? So I'm going to browse listings. I've got some cash left in my account. I'm just going to go ahead and make an investment right now. So I'm going to choose this guy right here, or this guy or gal right here who had, for the dental work. So I'm going to choose this one right here. It's as easy as this. I'm going to put in $25, 25. I'm going to add to cart. All right. And I'm going to place the order. And it's as simple as that, folks. Within 1 or 2 days, the order will be confirmed. When the loan actually funds, it'll show up in my portfolio. That's actually the first time I've made an active placement in years and years and years, by the way. But I just did that for demonstrations of this video. So if I go back to browse my investments, now you're going to see that I have $15 in available cash. Note pending, that's $25, and I still have $22,425.81. And if you can go back and you can look at my history, and you can see that automatically this is done pretty much every month, right? Where there's a completed purchase here, completed purchase there, completed purchase there. Every month there's several of these that are made for me. Now you're being paid back on these loans every month, a portion of principal and a portion of interest. So you don't, so you have more coming in than just the 5.35% or 5, whatever your yield is. You have more than that coming in because there's interest and principal. And so long as you're investing those principal amounts every month and a little bit of the interest, it's going to grow and grow and grow. And I've been setting everything to reinvest. I haven't taken any withdrawals on this portfolio since I put it together. But eventually, let's say I have a yield of around 6%, and my portfolio is $100,000 or $120,000. I could take out $500 a month in the future when I'm retired as sort of and you can set that up automatically too, automatic withdrawals. I could set that up to take out $500 a month. If I had $120,000 in there and I'm getting a 6% yield, I'm taking out $500 a month, and my income is still growing because a portion of that interest that I'm making is being reinvested every month. So not only am I living off of the investment income, or at least a portion of that is providing some living income for me, it's still going to grow over time too. So So from this perspective, this was a pretty good alternative investment asset class, I think. I don't know if it would be officially classified one as of yet, but it's not fixed income because there is no market for these loans. These are unsecured loans, by the way. There's no market for them. You can't buy or sell them. It's not stocks. It's not real estate. It's something that's just itself. So that's one of the reasons that I like it. A couple of the negative things with peer-to-peer lending is this. I cannot go to my investments. Okay, so one of the really negative things about this, and this is a big deal for some people, it's not so much for me because this is a small amount of money, but even when it's a larger amount of money, it won't be such a big deal. These notes down here, you don't have a market for them. You can't sell them. They are not liquid. So once you put the money in, you can't withdraw it. You can only withdraw the available cash that comes out every year. So you can't put in $5,000 of investments and 3 months later say, I want my investments back. You're not getting them back. I think there is a way to get them back, but the penalty is literally, it's just gigantic. There's no reason to even consider it. There used to be a market for those notes where you could sell a non-performing note, but they were getting looked at by FINRA to be treated as a security, and that would have caused all kinds of other layers of complications. So they decided to get rid of that marketplace. I do think that getting rid of the forums where you could talk to borrowers is a better idea. People were, including me, I was making decisions on who I would loan money to, even at $25, based on emotional things and whether or not I liked their personality or liked the way they wrote. None of that really matters. And I think that when I switched to auto invest, it proved it over time that even though I didn't think I was making decisions irrationally or emotionally, I probably was, and I've done better under the algorithm than I did on my own, so I'm going to stick with that.
Well, there you have it, folks. That is today's video on peer-to-peer lending. I hope you got an idea of how it's done and how you invest in these different little loan programs. If you're interested in doing this yourself, I do encourage you to do your due diligence. This type of investing is not for everyone. So go to those websites, ask for all of their documentation, read through everything, and then decide on your own. This is Jason, Certified Financial Planner with AdviseEdge, host of Fighting Words Financial, where we teach you how to fight for your own financial future. Please like and subscribe.